early. We are going to record this, so there will be a video presentation for you to review after if you have to hop on. And I know I've already spoken to many of you about what's transpiring and what we're doing, and I'm sure I'll be speaking to many more of you as the days and weeks go by. But I wanted to host a short informational webinar just to talk about the recent market activity, recap 2015, discuss where things are at right now, and provide you with some perspectives on the current market environment, how we're interacting with it, and what to be looking for going forward. And so thanks again for taking the time to be here. So as we jump in, just we need to give the brief disclaimer that this presentation is not advice. It's really informational, things that we may say, the markets, the investment choices and recommendations. It's fluid, it's dynamic process, and we have to, from a compliance standpoint, lay all of this out. So let's just jump in to just 2015 really briefly, and this chart shows different asset class returns for the 2015 year. The first bar is what's called the value line arithmetic index, and that's basically the median stock. It's about 1,700 stocks that are equal weighted, and it shows how the typical U.S. stock did this past year in 2015, and that was about a 7% loss. Bonds, which is the second chart, barely eked out a gain on a total return basis. That's the aggregate bond index. It was up less than 0.5%. Commodities had a very difficult year, down 27.6%, very much driven by oil and gold, which struggled throughout the year. This next bar is emerging markets. Those were down 16% for 2015. Meanwhile, European and developed international markets were down about 1%, and real estate through the REITs rose 1.62% for the year. So on the surface, 2015 looking U.S. stocks, bonds, it seemed rather benign. But underneath the surface in the second half of the year, things started to worsen from a global economic standpoint, and a lot of these riskier assets, stocks, foreign stocks, emerging markets, we're down, and we're down quite significantly. And there was a stat by Societe Generale that said the minimal gains in the U.S. benchmarks make 2015 actually the toughest year to generate returns in 78 years, going all the way back to 1937, where the Treasury bill actually beat out other major asset classes with a return of 0.3%. So as you can see, looking at this chart, there were really very few places of refuge, and even the bond market barely was positive for the year. And so examining all of this, performance, other research sources such as Bianco Research, they just concurred that 2015 was the toughest year for having an asset allocation strategy in almost 80 years. And even Warren Buffett himself had his worst year since 2008, down more than 12% in 2015. So where are we now? This is the chart of the S&P 500 and Dow Jones since January 1st, 2016. And it wasn't updated through Friday when there was a 2.5% improvement in the chart. But a lot of people have been talking about what's going on since the beginning of the year. And this chart really shows the decline from the start of the year. It ended up, the markets were down 10, 11% in the U.S. and foreign markets similarly. It has since recovered a good chunk of those losses. But there was a confluence of events, fears of a hard landing in China, oil breaking to new lows to below $30. There has been illiquidity in the credit markets and the high yield markets. There was forced liquidations, and a lot of hedge funds themselves even had to shutter its doors. And finally, the herd mentality, produced a big risk-off move all at one time, making what was the first couple weeks of the year the worst start for U.S. stock markets in its history. And beyond that, I think it's important to recognize that this is just a three-week, 1 month snapshot. But from their highs, from the U.S. market highs in 2015, global stock prices are down about 20% of their value, and which qualifies for quote unquote a correction in bear market. Correction people decline as 10% or more, bear market 20% or more. And so we've since recouped that, and a lot has changed. Not a lot has changed other than price in a short period of time. But we think that, this 1 month period where there's been some difficulties, it's important to stretch things a little bit farther. And this is looking at things from a 10-year perspective, going back from 2006. So even with the Great Recession that we experienced, it still shows that there's been a relatively decent performance despite how difficult those couple of years were. And putting things even into further perspective, the global stock market decline, it's really not unprecedented. These setbacks of 10 to 20% typically happen every year or two. So they are pretty much normal and par for the course. It just doesn't feel good when we're going through them. And even looking at a farther perspective, a longer term perspective, this is the S&P 500 since 1900. And you can see when we stretch things out, the chart always goes up and to the right. So longer term, the stock market is a positive wealth creating machine as long as we're interacting with it properly. But you can see that things go in cycles. There's a lot of time periods where things go sideways and the market doesn't make a lot of progress. Then it has big up moves, and then there's a down move, and then there's sideways progress, and then there's a big up move and sideways and another upward bull market. And then you can see from the top in 2000 to about 2013, we had a big sideways period where the market did nothing, and it's since broken that level. And perhaps it's entering another longer-term multi-year bull market, and this is simply just a period in it where there may be a decline of 20% or more as part of the natural ebb and flow of the market. So here's some perspective as we talk about the market's returns. And this chart, we want to be clear, it basically shows the S&P 500 from 1980. Each bar represents 1 year, and it shows the intra-year decline versus the actual calendar year return of the market. So if we start off on the left side of the chart, on average, these negative red numbers at the bottom show the average, the biggest decline in price that the S&P faced throughout the year. And on average, the stock market has intra-year declines of 14.2%. So every year, a 14% decline would not be unusual. It's actually pretty normal. And many of the times, even with the markets having big declines, the years even end up being positive. So if you look back to 1980, the market suffered a 17% decline at one point throughout the year, but ended up 26% that year. So 3 out of every 4 years, the market has been positive in terms of total return, even with the fact that there's 17, 18, 17, 20% losses at some point throughout the year. And so year to date, yes, we've had an 8%, 10% decline, but looking at this chart, how the year finishes, it does not say anything about how the year will finish, because many of these years there's been big declines, but the years turned out to be positive. So it just provides some perspective that these types of market fluctuations are not out of the ordinary. They're not unusual. They will happen. They're going to continue to happen throughout our investment lifetimes, and we need to make sure that we interact and behave properly throughout these short-term market fluctuations. And so a couple of things that I think it's important to just point out, that there have been market declines of 20% or more, about 1/4 of all the years. And despite that, stocks ended up positively. So it's important to remain invested than trying to figure out exactly how we're going to get our portfolio in all cash at one period of time and then go to stocks and hope that we time everything perfectly. It's very difficult to do that on average. And so despite the fact that we've had this big decline to start the year, we can even just take a little short-term sample. This is not every single year an example, but 2009 when the bear market in the Great Recession and the stock market finally bottomed, you could see that the year started out really poorly. January, February, March, when the market bottomed in March, things looked pretty dire, and the year actually ended up 20% in 2009. So just because the year starts off badly says nothing about how the year is actually going to finish. And so we need to maintain our perspective throughout these moves in swings in the market. There's something that I want to talk to you about, and I think I've stressed it in the past, but there's a point in time where negativity and people's fear about the stock market actually creates a positive environment for stocks going forward. So this chart shows the American Association of Individual Investors, a sentiment survey that they send out every week, a list to their database for people to respond. Hey, are you positive or bullish on the market? Are you neutral on the market? Or are you bearish and negative on the market? And on the left-hand side of this chart, we can see the different range of readings from 1987 through January of 2015. And there's been people that were bullish on the market as low as 15% in 1990 to as high as 75% in January of 2000 when the tech bubble topped. In March 2009, this far chart shows bearishness. And so in March 2009, it had the highest reading of people who were negative and scared and bearish on the market at 75%. And we all know what happened there. The market actually bottomed in March 2009, when everyone was at its most scared. And there was the least amount of bears in August 1987, just before the market had its crash, its Black Monday crash in 1987. So to provide some current perspective is that to start the year in January, after that first week of January, we had one of the lowest bullish readings ever in this sentiment survey. And it's not really surprising considering how the year started, but what happens from a market return standpoint is that if you look at when people are the least bullish or the most bearish, the best returns happen from that standpoint. And so we want to be thinking when everyone else is scared, that might provide a very good opportunity going forward. And there's a little bit of a historical study here which pulls up the least amount of bullishness and the most bullishness, and it shows the actual returns of the market for the next year. So right now, we just encountered one of the least bullish surveys ever. Well, the next year's returns from the least bullish periods had 13.2% returns over the next year. Meanwhile, is positive on the market and everyone is really bullish on the market, next year's returns don't even reach 1%. So when everyone is positive on the market, that's usually a sign that there's not a lot of new demand or new buyers because everyone's already bought into the market. And when everyone's out of the market or very bearish or they're not positive on the market, that produces very good opportunities in the time frame ahead. So this doesn't have a crystal ball, but we can see that currently we were at one of the lowest readings ever, and we were at higher than average readings in bearishness. So it wasn't extreme on all ends, but there certainly was a lack of optimism in the market. And you can see since that reading, the market has actually recovered and bounced quite significantly. So it pays to understand that negativity and the global consensus is actually a positive from an investment standpoint going forward. And another thing to pay attention to is new lows. And a lot of times the market is doing really well when there's a lot of new highs. But on January 20th, new lows means a stock hit its lowest point for the year. And this chart is basically showing that on January 20th, 1,410 stocks registered new lows on the New York Stock Exchange. That's been the highest total outside of the 2008 crash. So that equates to more than 40% of all stocks hit a new low. And usually when that happens, it's kind of a sign of a climactic bottom, or everything is completely sold out. There's only been a few other occurrences where these type of new lows, the significant confluence of new lows and stock making new lows, happen at market tops. Oftentimes they happen at market bottoms, and you can see many of the times these very high new low readings happen near market lows. This is 1987, this is 1970, this is 2008. A lot of times these market lows are happening after the correction. They're happening after things are sold, and then they create better opportunities going forward. There was only 2 occurrences out of 15 that led to further declines. So it is a glimmer of hope in the fact that this market is very much sold out in the short-term time frame. So when everything looks its bleakest, actually produces an opportunity to gain going forward. And even if this is a bear market, and globally we're right on the cusp of that, in the U.S. not quite so from the S&P 500 and Dow standpoint, but it's important to maintain patience and perspective. And this is a fact. Since 1945, if you would have invested $1,000 in the S&P, that would be worth over $1.5 million today. But along the way, you would have encountered 13 different bear markets, 13 different periods in which you would have lost, on average, 30% of your money that would be invested in the stock market. So these bear markets are going to happen throughout your investment lifetime, but it's not to say that you shouldn't be investing. You've got to be investing through them in the proper way, because that is how the gains will be achieved. It's not timing the market, it's about the time actually in the market that allows you to compound your wealth over time despite the fluctuations that are encountered. And here's a snapshot of how bad these bear markets actually were. And you can see that of the 13 bear markets in the S&P 500 since the end of World War II, we can see how long they actually were. In 1946, the duration of the bear market was 36 months, or about 3 years. Other bear markets have lasted anywhere from 4 months, 3 months, 20 months, and they've recovered. They all have recovered. And I think that's the other thing that you need to take from this. Each one of these bear markets has actually recovered, and they typically recover within 3 years or less. And this is the actual decline of the most recent 2007, the Great Recession. The S&P lost 57% of its value. The tech bubble lost 49% of its value. The crash of 1987, the market lost 34% of its value, and it recovered within, the bear market lasted about 4 months, and then they recover on average within 3 years. So this is some perspective that they always have recovered. The length of time to recovery certainly varies, but it has happened, and it will continue to happen even if we experience a bear market in the future. And here's some other statistics about global bear markets. These are global stock prices since 1980. And this includes the U.S. It also includes international markets. And it really paints a picture that global corrections, even global bear markets, are pretty common. And since 1980, the global stock market has experienced 12 corrections, which is a 10 to 20% decline, and 7 bear markets. So the attention-grabbing downturn happens on average every couple of years. So we need to realize that over the past 36 years, stock prices have spent about almost a third of their time in corrections or bear markets. But you can see that the average time to recovery of a correction, which is anywhere from 10 to 20%, is about 121 days. So the market typically recovers from a correction within less than a year. A bear market, it certainly takes longer because the declines are longer. You can see that the average time from the peak to the trough, which is the peak of the market to the bottom, is about 1 year, and the average time to recovery is a little bit over 2 years. So global bear markets, from the top to the bottom to the top, it's about a 3-year period in which it takes to recover and get back to where it previously was in its previous highs. So again, even globally speaking, corrections happen frequently, but they also recover in a reasonable period of time. And this next chart, I think it's important to recognize the importance of patience, the importance of having a portfolio that's invested for a longer term period. Because if you're investing for less than 5 years, your money shouldn't be in the stock market. And so this chart shows the different investment timeframes, whether it's an investment portfolio of 1 year, 5-year rolling period, a 10-year rolling return period, or a 20 rolling return period. And it also shows the range of stock and bond returns, as well as a blended portfolio of half stocks and half bonds. So on a 1-year period, you can see that stocks have had as good of year in 1 year of 47%. They've also lost 39% of its value on a 1 year in a 1 year period. If you stretch your time frame out to 3 years, average return, the average annual return has been as high as 28% and a loss of 3% average annually over a 5-year period. But here's what's important to notice, that if we were to include bonds, if we were to take a portfolio that was all stocks, but now include half of that portfolio in bonds, there has never been a 5-year period going back to 1950 in which a portfolio of half stocks and half bonds has actually lost money. So that's where maintaining that perspective, maintaining the investment portfolio's time frame to 5 years or longer and including other asset classes gives yourself the ability to tolerate some of the fluctuations, and the likelihood of losing money is very low unless whoever is managing the portfolio is panicking or we're buying high and trying to time things and it just doesn't work out properly. And so as you stretch your time frame out farther and farther, there's actually never been a period in the last 65 years with a stock portfolio losing money over a 20-year period. Its worst 20-year period was a 7% gain. Its highest was gain. And you can see here the average annual total return for stocks going back to 1950 was 11.1%. For bonds, 6%. And a portfolio of half stocks and half bonds returned 8.9% on average on an annual basis. So 1 year, anything really can happen. But once you start adding some diversification in your portfolio and stretching your time frame slightly longer than the year, the likelihood of actually losing money just being an investor in the financial markets is pretty low, unless there's some bad behavioral decisions along the way. And you can even see here on a 10-year basis that the stock market has had a period where it's lost 1% per year for over 10 years, but typically gains happen the longer we can remain an investor. An important factor when investing is rebalancing. And people may have heard this term before. They might not necessarily know what it means, but we thought we would share it with you. And so rebalancing is the process of actually taking a portfolio and putting it back to its original composition. And that's part of having a winning investment strategy. So it requires you to buy what has done relatively poorly and sell what has done relatively well and perhaps is at higher valuations. So let's say a portfolio that you are invested in has an asset allocation of 70% stocks, 30% bonds. So if the stock market does poorly, and the portfolio composition now declines to 65% stocks and bonds then increase to 35%, you would be selling your bonds and buying stocks which have done poorly to get you back to your original target mix. And this chart is a hypothetical portfolio of several Vanguard funds, some total stock market index, some small cap funds, international stocks, emerging market stocks, and bond market funds. This goes back from 1997 to the end of 2013. And you can see here that the returns for every dollar invested were actually better for the portfolio that was rebalanced on an annual basis than the portfolio that was not rebalanced annually. So sticking with your asset allocation and investment plan actually helps during the inevitable sell-offs. It will be forcing you to be buying low and forcing you to be selling high once things have done well. Better returns aren't necessarily guaranteed from rebalancing over time when stocks are in a long-term uptrend, but the best times and the biggest benefits comes at times when markets go in different directions, allowing you to take advantage of the differentials in performance across different assets. And so diversification is not totally optimal unless you use rebalancing to take advantage of the fact that these different asset classes and even sub-asset classes perform differently over different cycles. So it's an important part of ongoing portfolio management that the rebalancing can actually increase your return and lower your risk. So you can see this rebalancing portfolio in the 2008 period, it actually lost less than the portfolio that wasn't rebalanced. So it not only can enhance your returns, it can also reduce risk at the exact same time. The next thing that I do want to talk about is that U.S. stock market valuations are high. And what we are experiencing, the volatility that we've seen over the last 6 to 8 months starting in October, it's long overdue. You know, the S&P in the U.S. markets, to me, are really the last shoe to drop. And by having these periods, it also will create opportunities to invest in the other asset classes that provide more value and better risk reward going forward. That's 2016 and beyond. What happens is other investors, they see this market, they get scared. They're forced to sell, they panic. That creates good opportunities for ourselves and our clients because there is a price that compensates us for taking a particular set of risks. And our focus is to continue to take diversified risks that are priced cheaply, that are better values than the average asset class. And we also need to be mindful that we're not investing 100% of anyone's portfolio in one asset class or the S&P 500. They are diversified in many different asset classes that will have different performance and different valuations going forward. So our investment thesis continues to include a diversified portfolio and including international stocks and emerging market stocks. Our analysis suggests that both of these markets are actually undervalued relative to their normalized earnings stream, despite the headlines that we see that have happened in Europe, in China, in Brazil. Those create opportunities when everyone's negative and when the markets have been beaten up. And conversely, when it comes to U.S. stocks, which have been better than all the other asset classes over the 5+ years, our outlook is less positive compared to these foreign markets going forward. We see that the primary home field, the primary U.S.-based investments are not very active respective to their potential to generate returns going forward. And therefore, we have greater diversification internationally than a typical U.S.-dominated portfolio. This is a global portfolio. This is the MSCI All Country World Index. And it basically shows that the United States is 53% of the global market cap. And so what that means is that U.S. stocks represent about 53% of the world's stock market holdings. Most people in the United States typically invest 80% or more in their home country, in the U.S. stock market. But as you can see, there are so many other markets. There are so many other opportunities and valuations across the globe that remaining simply a U.S. investor is ignoring half of the world's opportunity. And so our portfolios take a global approach. They're looking at the landscape globally, which will provide different valuations, different rebalancing opportunities going forward. And Vanguard, which is the behemoth of the index investing fund world, has recently said, invest own portfolios with a high degree of home bias should take advantage of the global diversification benefits by rebalancing towards non-U.S. exposures because of that opportunity set. And that is something that we have been doing over the past year or so. So it's important to remain globally minded. And when we talk about returns, these are return expectations, and we need to be reasonable, knowing that no one can predict the future. We need to make the best assumptions that we can going forward. And the expected returns of global markets, are slightly higher than the U.S. itself. So you can see that, the global equity market, the 10-year projected or estimated returns are closer to 9 to 10%, whereas U.S. stocks are closer to 7% per year. So the opportunities for greater returns are enhanced when looking outside the U.S. going forward due to their valuations. And so medium term, 5, 10 years, we are not expecting 10-plus year annual returns or 11-plus% annual average returns that has been experienced from 1950 to 2015. We're being much more guarded in terms of what we would be expecting going forward, just due to the valuations of the U.S. market and foreign markets. And so if one were to have a 60% stock, 40% bond portfolio, we would be expecting earnings or returns on an annual basis to 7% real, 5 to 7% total, or about 3 to 5% real after inflation. This is about 2.5% lower for the same 60-40 portfolio dating back to about 1926. So we need to be tempering our assumptions in terms of what we would expect returns to generate going forward. So let me repeat that. Returns are likely going to be lower in the decade ahead. There's still plenty to be had. It likely will be more volatile, but a 60-40 portfolio, real returns after inflation will be about 3 to 5% for a 60-40 portfolio. And this is about anywhere from 2 to 1% lower than what was experienced over, the last century or thereabouts. And so just getting into our positioning and, where we are today, we have a core portfolio that is really diversified across a lot of asset classes. And we want to emphasize the power of portfolio construction. And we believe that the ultimate measure of risk is the likelihood of loss of principal as opposed to volatility. And if we maintain our portfolios according to the right time frame and make sure risk is minimized for our longer term financial futures, we can be investing intelligently. And so our core exposures, our core growth, our core conservative asset allocations are globally diversified. They look similar to the MSCI index that we just showed that has about half U.S. half international exposure. We also have international exposure in our fixed income portfolios as well. And we also maintain a flexible part of our portfolio that will rotate systematically and is rule-based based on what's actually transpiring in the financial markets. And so right now, over the last couple of months, what's been held in the flexible part of our portfolio is we've had allocations to cash, we've had allocations to REITs as well, which have performed better than the stock market has over the last several quarters as well. So we want to remain in tune with actually what's going on with the market, but we will never take this flexible portfolio and turn it into the whole portfolio because there's risk in not having any money invested over the long term. So we will use some of it to be dynamic, to manage risk, and to take advantage of the opportunities that we see going forward. So I know for many of us, myself included, the current sell-off, it doesn't feel great, but the environment today, as we see it, is far different than that of 2008. There seems to be a lot less systemic leverage in the system that would create a wider contagion or systemic stress in the system. what's happening is likely just a normal correction that usually happens on every couple of years, except it hasn't in the U.S. market for a handful of years. It's likely just long overdue, and this is going to set the stage to capitalize and create return going forward. And so we're optimistically, and we're optimistic and rationally so that, the markets are going to be volatile, but that's going to create opportunities, and that the fundamental drivers of long-term returns haven't changed. Valuation will continue to be an important part. Growth will continue to be an important part. And despite the fact that there are these short-term market movements, they may become at odds with long-term outcomes. There's going to continue to be compelling long-term opportunities for us to take advantage in this volatility. So yes, it doesn't feel good, but this also creates opportunities for the portfolio, for ourselves going forward. So I hope that helps provide some perspective on what's going on in the world, what's going on in the markets, and we are optimistic that there's going to be some volatility, but that it's actually going to be good for our strategies, for our clients going forward. And I welcome anyone to email me with any questions that you may have. And, I look forward to hearing back from you. And I appreciate everyone taking the time out of their busy schedules to be a part of today's call. And we look forward to doing these again in the future. Please shoot me an email, matt@illuminationwealth.com, and we can chat more about your personal situation anytime. Thank you so much. Look forward to talking with you soon.